Hello, my name is Irma Camila Lopez Rodriguez. Today I am going to talk about accounting. In accounting, we use accounts to record all the financial transactions of a company. Accounts are classified into three main groups: assets, liabilities, and stockholders' equity. Each account has a normal balance, which can be debit or credit, and this tells us whether the account normally increases with a debit or with a credit. In this video, I will explain 5 asset accounts, 5 liability accounts, and 5 equity accounts, including what they mean when they increase or decrease in their normal balance. Let's start with asset. The first asset is the cash. Cash represents the physical money available in the company coins, bills, and petty cash. Cash has a debit nature. It records the money available in cash and checks to cover immediate expenses. It is debit when money comes and credit when money goes out. The balance is always positive or zero, never negative. These accounts allow the company to make daily transactions without delays. Liquidity control is fundamental to maintain a healthy cash flow. It works with physical inflows of money, such as cash sales or a loan received. For example, if a customer pays $500 in cash, we debit cash $500 and credit sales $500. Next, banks. The banks has a debit nature since it is an asset account. It represents the money the company has deposited in financial institution. This account increases when deposits and decreases when payments or withdrawals. It is debited when money enters the bank and credited when payments are made. It reflects the company bank balance, which are used for transfer, checks, or electronic payments. The example: if we deposit $200 from sales into the bank, we debit banks $200 and credit $200 cash. Next, merchandise inventory. Merchandise inventory is debited for the value of the initial stock, purchases, and expenses related to purchases, and is credited for sales, returned, or purchase discount. Its normal balance is debit because it represents the good available for sales. Example: if we purchase $500 in merchandise on credit, we debit inventory $500 and credit accounts payable $500. Okay, land. Land is a fixed asset. It represents the properties a company owns and uses in its main activity or keeps as a long-term investment. Land is not subject to depreciation due to its limited duration. It usually does not decrease unless it is sold. It is debited when land is purchased and credited when it is sold. Its normal balance is debit. If the company buys land, for example, if the company buys land for $20,000, we debit land $20,000 and credit cash bank $22. The next, buildings. Buildings have a debit nature. This means that an increase in the value of buildings is recorded with a debit and decreases with a credit. The buildings account reflects the acquisition cost of structure owned by the company. It increases when a building is purchased and decreases when it's sold. Over time, depreciation is applied to reflect wear and tear. It is debited when a building is acquired and credited when it's sold. Now, apart from assets, we also have liabilities. Okay, liability, it's bank loans. The bank loans account represents the company's debts with financial institutions. They may be short-term or long-term, depending on the maturity date. It increases when the company receives borrowed money and decreases when payments are made. It is credited when the loan is obtained and debited when it is repaid. Its normal balance is credit. And for example, if a company requests a 500,000 loan to buy machinery, that debt becomes a liability, since it must repay the bank with interest within a certain period. Next, taxes payable. Taxes payable recalls the tax obligations the company has with the government, such as VAT, income tax, or payroll taxes. It is usually a short-term liability. It increases when taxes are generated and decreases when they are paid. It is credited when the tax is recognized and debited when it is paid. Its normal balance is great. For example, if at the end of the month the company owes $800 in taxes, the account is credited. When payment is made to tax authority, it is debited. Next, mortgage payable. Mortgage payable represents long-term debts secured with real estate. It is a liability with long repayment terms, usually several years. It increases when a mortgage loan is received and decreases when its amounts are paid. It is credited with the loan and debited with the payment. Its normal balance is credit. For example, if the company takes out a $2 million mortgage to buy a warehouse, mortgage payable is credited. Each monthly installment reduces the balance with a debit. Notes payable are debts backed by non-formal documents such as promissory notes that must be paid over long terms. It increases when the note is used and decreases when it is paid. It is credited when the debt is created and debited when the payment is made. Its normal balance is credit. For example, if the company signs a promissory note for $500 to be paid in 2 years, notes payable is credited when the debt is settled. It is debited. Finally, we have stockholders' equity. The first, capital stock. Capital stock represents the money that partners or shareholders invest in the company. It is the owner's support and reflects their participation. It increases when partners contribute more capital and decreases if it is withdrawn. It is created when capital is invested and debited when it is returned. Its normal balance is credit. For example, if a partner invests $1 million, capital stock is created. 2. The next, legal reserve. Legal reserve is a portion of retained earnings that by law must be kept as a security fund. It protects the company against future losses. So it increases when part of the profits is allocated